Hello guys, and welcome to Smart Risk. In this episode we will show you how to use trendlines like a professional trader, including our advanced trendline trading strategies and techniques. So, if that is something you are interested in, make sure that you subscribe to our channel and hit the notification bell to know exactly when we release new content. Also, comment below and tell us what topic you want us to cover since we look at them to decide what to do next. So first, what is a trend line? A trend line is a line that connects the swing highs and swing lows in the trending market. So here we have a clear uptrend. We have an impulsive move and a corrective move. Impulsive, corrective, and so on. At the top of each impulsive move, before the corrective begins, this is what we call a swing high. At the bottom of each corrective move before an impulsive begins, this is what we call a swing low. So what this means is, in a clear uptrend, the price will make higher highs and higher lows. Now a trend line is applied to connect the swing lows along the bottom and the swing highs along the top. So let's move on to a downtrend. Here we have a clear downtrend. We have an impulsive move and a corrective move. Impulsive, corrective, and so on. At the bottom of each impulsive move, before the corrective begins, this is what we call a swing low. At the top of each corrective move, before the impulsive begins, this is what we call a swing high. So, in a clear downtrend, the price will make lower lows and lower highs. Now a trend line is applied to connect the swing highs along the top and swing lows along the bottom. Now, here's an important point. Price won't always move this smoothly during the trending markets, but we show you this as an indication of what a clear trending market looks like. So why do even we draw trend lines? The first reason is trend lines can act as a support or resistance. Here at the top, the trend line acted as resistance when the price reached it. And along the bottom, see how the trend line acted as support. So, here is an important point. We don't enter trades just because the price touched a trend line and it can act as support or resistance. We always wait for price action entries in combination with other factors, which we will discuss later in this video. The second reason we draw trend lines is that breaking a trend line can signal a possible trend change. Now here at the top, we had an uptrend for a while. We had our trend line placed along the bottom of the uptrend. Once the price breaks this trend line, it shifts from an uptrend to a downtrend. Again, once this downtrend starts, we put a trend line above the swing highs. And once the price breaks this trend line, it changes from a downtrend to an uptrend. Now, here is an important point. We don't enter a trade just because the trend line has been broken. We combine this factor with price action techniques and wait for entry signals, which we will discuss later in this video. So, now that we know what trend lines are, and why we apply them to our charts, let's discuss how to draw trend lines properly. So first, let's start with the concepts we follow in drawing trend lines. First, obvious trend lines are better. Look for a trend line that is obvious and easy to draw, because it means that more eyes are watching it. Second, more touches, the better. More touches are better, but it will not guarantee that it will hold next time. Third, trend lines are areas, not solid lines. Like support and resistance, treat them as areas, not a specific price. Fourth, do not force a trend line. Use trend lines as guidance to your overall analysis, not a law. Now that you know the concepts of trend lines, let me show you how to draw trend lines properly. So here is a question we often get. Do you draw your trend line through the candle closes, or the wicks? And the answer is to draw the trend lines where you can get the greatest number of touches. Candle bodies or wicks don't matter. So here was your clear downtrend. And to hit all these points here, this is where you could have placed your trend line. Now, notice how in some cases, trend line touches the wicks. In some cases, we have hit the candle bodies. And even we have no touches in some of them, which is perfectly fine. So same along the bottom. This is how we would place our trend line to get the greatest number of touches possible. Once again, here trend line touches the wicks. Here the body of candles. And these we could not get. So here comes an important point. As swing highs and swing lows change over time, adjusting the trend line to the most suitable position is fine. Because we use trend lines as guidance and treat them as an area, not a solid line. Now that you know what trend lines are and how to draw them, let's jump into the strategies of using them in combination with price action. But before we continue, if you are feeling generous, please hit the thumbs up and subscribe buttons to motivate us to make more videos more often. Also, comment below with your questions and thoughts and we'll work our best to answer all your questions and create videos around your requests. So, we combine trend lines with price action in two major ways. First, we have a trend continuation trading strategy. And second, we have reversal trading strategy. Let's start with the first one, the trend continuation strategy using trend lines. Let's break this down step by step, how we read the market structure and price action. In this example, we only use a one time frame to explain things, which is the daily time frame. Later in this video, we will show you how to use multi-time frames. So first, it is obvious that this is a moving downtrend as the price is making lower lows and lower highs. So we want to trade in the same direction with the moving downtrend. Second, we will connect these 3 points and draw the trend line. Also, remember to have it stretched further in case the price comes back up to it. Third, if we look left, we could spot this support level turn resistance here and had it drawn in. Fourth, we have identified this area where support and resistance crosses a trend line. This level is also what we call an area of high convergence. An area of high convergence is where multiple price action concepts meet, making it an optimal trading zone for high probability trading setups. This means that many traders focus on this area, and there is a higher probability that they will be taking action when trade opportunities arise. Let me explain to you how. This area is of high convergence because a lot of traders are watching it to place a trade based on support and resistance, trend line, price action and candlestick, or the confluence opportunity. All of these traders with different trading styles observe this area for possible short trade entries. So, when the price starts approaching this area, since we already highlighted this level, we are watching to see what the price will do once it gets here in terms of price action. So this is what goes through our minds. We won't enter a short trade immediately once the price gets to this key point. Because it does not matter how good an area is. We won't enter trades blindly. We always wait for price action signals because the price can easily break through. So notice how the market reacted to this area by printing an engulfing candlestick, not breaking through and rejecting downwards. Now, at this point, you could have had an aggressive entry here. But there is still no trade for us because a reaction to an area does not mean a reversal. Do not forget that this is a moving uptrend in the lower time frames. Now here is the key point. To enter a trade, after rejecting a key area of convergence, you put a trend line under the secondary moving trend, and wait for a break of the trend line to occur, to confirm that the moving uptrend is over and that the higher primary downtrend can continue. This is a fundamental concept to understand because even though your primary trend is a downtrend, your secondary trend is an uptrend. The moving uptrend can continue, and break through the resistance, and trigger a major trend change. This is why the short-term trend needed to be over through the trendline break, so that the long-term trend could continue. Now, another important point here is that the break of the short-term trendline occurred after the rejection from the resistance area. Otherwise, you would have just had a short-term trendline break and nothing else. This could not be very clear. So let's recap this once more to highlight the points. First, our primary trend was a downtrend, so we had a big picture bearish bias. The problem is that your short-term trend was an uptrend, meaning the price is currently moving with bullish momentum and can easily break through your long-term trend line. This is why we needed to wait and see if we could get bearish price action to occur inside of the short-term uptrend, so that the short-term trend would be bearish to match the long-term bearish trend. Our bearish price action then came in two elements. First one was a reaction to the resistance area of high convergence. But more importantly, this was confirmed by breaking the short-term trend line. And at this point, the short-term trend turned bearish to match the big picture downtrend. And you could trade on the trend line break through a momentum play, or use any other strategies as you now had your directional bias confirmed a short or down. Now here is where we take our trading to the next level. We will zoom to lower time frames analyzing the price action just like we did on this time frame. So we could have taken an even earlier entry, which you will get into now. So let's jump to that. So in this example, we are going to show you the same concept, but take it a step further and apply it to multi-time frames. Now, this is the daily time frame. So first, we identify that this is a moving downtrend as the price is making lower lows and lower highs. So we want to trade in the same direction with the moving downtrend. Second, we will connect these 3 points and draw the trend line. Again, we will have it stretched further in case the price comes back up to it. Third, if we look left, we could have discovered this interesting area here. This is a key level of structure with multiple rejections that now can act as resistance. Fourth, we have identified this area of high convergence where the major level of structure crosses the trend line. Now, as the price came up to this point, we had no idea whether the price would break through or reverse. Because again, although your big picture trend is bearish and a downtrend, your short-term trend is bullish and an uptrend. Which means you have a conflict in your directional bias. So to solve that, you need to wait for bearish price action to print itself after hitting the area of convergence, to confirm that the short-term trend is over and the price can now continue to move to the downside. Or else there is no trade. So in this case, we zoom into lower time frames to observe price action more in depth and have more precise and early entry. So here we have the 4-hour time frame. Here we have the same resistance level on the daily time frame. Here is the same trend line. On the daily time frame, you couldn't see much detail, but in 4-hour you can see the swings inside the short-term uptrend and the price action once we get to the area of high convergence. Now, here there are many ways to enter the market. You could have placed a tight short-term trend line below the secondary uptrend, and once we broke through the trend line it could be our short entry signal. Or we can see that once the price got to this area, it made a double top, which is one of our favorite reversal chart patterns. So an aggressive trade would have been entering a short trade right after the engulfing in the momentum candlestick. That happens to be the second touch of the double top pattern. More conservative trade would have been waiting for the double top pattern to be completed by the breaking the neckline to the downside. Now, again, there are many ways to enter the market. But the key point here is that this all occurred after the rejection and bounce from an area of high convergence, or else you would have had just a simple break and retest. Another important point is that trend continuation strategies are not limited to these time frames, so you could use them in any of them. But remember, things you find in the higher time frames hold more weight. So now that you understand how to use trend lines for trend continuation trading, let's move on to the second way to use trend lines, which is by reversal trading. So in this part, we are going to explain the reversal trading strategy with trend lines. But before we do that, if you are enjoying so far, please give this video a thumbs up and click on the subscribe button to watch more videos like this. Now here, let's break down our analysis step by step in 4-hour time frame. Now, this is a clear moving downtrend. First, we identify our trend line through these points here. Now, we can establish that the trend line has been broken and the trend can reverse from now on. But the problem is a trend line break can often be a fake out. So, what we do is, we look for key price action reversal patterns that have formed right before a trend line break. Now there are many kinds of reversal patterns you can look for, such as double tops or double bottoms, head and shoulders, triangles, and etc. And the reason you want to identify a reversal price action pattern right before a trend line break is that you are going against the dominant uptrend. So, the price action pattern we got was this double bottom. Now, what does the double bottom tell us in terms of the price action? Well, it shows that price failed to make a lower low, which means this is a loss of momentum. Now in the second step, we can identify this key level that has acted as both support and resistance. Third, we can identify this area of high convergence, which your key level and back of the trend line cross. Now that we identified our optimal trading zone, let's jump into the lower time frame to have a more precise and early entry. Now here in the 1-hour time frame, we can observe much more detail once the price gets to the area of high convergence. Again, you could place a trade with many entry strategies. But for us, breaking above this consolidation area would make a great opportunity to enter the market. So remember, combining all of our analysis, including reversal pattern, trendline break, and identifying the key level of structure, made this entry a high-quality trade. Increasing trade quality is also knowing when not to take trades, which is just as important as knowing when to take trades. So if you want to learn more about our trade entry strategies, subscribe to our channel, and if you enjoyed this video, please give it a thumbs up to support us for making more videos more frequently. Also comment below with your thoughts and what kind of topics you want us to cover. So thanks for watching, and I'll see you in the next episode.